Hello everyone, I'm going to review Enbridge Stock, one of Canada's most beloved companies for dividends. And of course, everyone loves them because they've been paying dividends for the past 65 years. Yes, 65 years. And most importantly, they've been paying and increasing their dividends for the past 20 years, which makes them a dividend king. Now, I'm going to go through the company and do a review and analysis of whether the past 3 years, which has been 10% increases in their dividends year over year, is sustainable for the future. Lastly, I want to check, is there opportunity right now? In today's video, I want to review Enbridge as a stock based on its Q2 earnings because that's going to give us an insight. Is there opportunity in this company? Also, I want to check out, is the dividend safe? And most importantly, is it a good investment right now? So if you hold Enbridge stock or you're looking to buy more Enbridge stock because it's been a fabulous dividend paying company, you got to check out this video. Hey everyone, smash that like button, hit it, so that you let me know to make more of these videos for you. And please, guys, if you are new to this channel and want to learn about stock investing, real estate investing, or growing as an entrepreneur, then you got to subscribe to this channel because that's what I'm going to be talking about so that you invest with confidence, clarity, and conviction. So please be a subscriber and hit that bell notification button so you get the latest and greatest videos coming to you. Plus, it's free. So let's get back with the video. So what is Enbridge all about? So before I jump into earnings, I'm going to give you a brief primer of what Enbridge is all about. Enbridge supplies and is responsible for 25% of all the crude oil in North America. Also, it's responsible for 22% of all the natural gas in North America. So this is huge. Now, the most important thing is that they actually are not they don't track commodity prices. Really, the way they make money is they enter long-term fixed contracts, about 25-year contracts with all the oil producers in North America. And so what this really means is that they don't track commodity prices, which is amazing. This is super important. How they get paid is based on volume. So the oil producers track commodity prices, they pump the oil, then they need some way to get across North America, and this is where Enbridge is responsible. They provide all the pipelines all across North America. They're responsible for all that regulatory and legal stuff between provinces, and what they do is that they charge these oil producers a fixed price or a certain price based on volume to get that oil from point A to point B. So essentially, Enbridge's business model is really based on these 20 to 25-year contracts, which means to an investor is that they've got some predictable reoccurring revenue. Okay, now let's dive into Enbridge's revenue. So when I look at the revenue since 2014 to 2020, I can see that the revenue has been increasing over time, which is really, really good. But a key takeaway is that during the oil market crash around 2013-14, around that time period, the revenue actually flattened shortly after, between 2015 to 2017. I would say this is a pretty important point that it gives us a bit of insight of the potential future for Enbridge. Another important piece I'm taking away from this revenue graph is that its revenue has actually dropped pretty drastically in the last quarter. I mean, because of obvious reasons, because of the situation that we're in. Okay, so let's look at Enbridge's earnings. As we can see, the earnings have actually been doing very well for the past few years, which is great. Now, remember I showed you the graph of its revenues between 2015 to 2016 experienced a bit of flatness in revenue. And that happened shortly after the oil crash around 2014. Now, of course, what we experienced this year is that oil had a mega crash. In fact, it went to negative territory. And what the analysts are trying to say in its forecasted earnings for Enbridge is they're predicting a big drop in revenue and not recovering until 2023. So if past history has taught us anything about the Enbridge stock, as much as it doesn't track commodity prices, it does take a hit in its revenue. At least that's what it showed when the oil crash happened around 2014, and its revenue did drop a bit. And what we're seeing is that this is also predicted in its earnings by all the analysts. We're seeing a flat line in its earnings and a bit of a drop between 2020 to 2022. And then we're not going to see a recovery until 2023. And even at that time, it's going to stay pretty flat. So that is what the analysts are all saying. So let's look at its debt profile. We just saw that Enbridge has $67 billion in debt. But let's check out how it's been handling this debt in the past few years. So when I look at its debt profile, I could see that actually Enbridge has been actually drastically incurring more and more debt since 2014. In fact, it's more than doubled its debt since 2014, which is actually not a good. And I see this is actually a bit of caution for me. Okay, let's jump into Enbridge's dividend. Now, like looking in this graph, Enbridge has been growing its dividend beautifully. In fact, in the past 3 years, it's been increasing its dividend 10% year over year, which is like amazing. And of course, this is a big dividend king. They've been paying dividends for the past 65 years. But what's important to me as I'm looking at this graph and considering that the revenue is going to drop in the next couple of years, the analysts are also saying that they are projecting the dividend to be not growing as fast as the past history. So is this dividend sustainable? So we're going to look at the distributable cash flow because that's what's really important. Does it have enough cash in the upcoming quarters to actually be able to afford the dividend? So what it's projecting is that it's reaffirming in its recent presentation that in 2020 they are going to have a distributable cash flow of 4.5 to $4.8 per share. Now it's paying out about $3.24 per share. So what it's saying is that it can afford to pay out its dividends for this year. Now, I think that there is still a word of caution because I'm seeing the revenue drop. So I would suspect that if the revenue is going to drop over the next 2 years and its cash flow is going to obviously it's got to drop somehow, or it's going to be cutting other ways in the company, that they're likely not going to increase its dividends like 10% year over year is what I suspect. And another way of looking at this is that as much as its revenue is going to drop in the next couple of years, it has a long history of paying dividends. In fact, it's been paying dividends for the past 65 years. So it paid its dividends during the oil crash, it paid its dividends during recession, but of course it may have not increased its dividends so much, but it still paid out its dividends. So it has a huge track record of paying out its dividends. My takeaway from looking at financials was that I didn't like how much debt that they're carrying, and they haven't actually done a lot to decrease the debt in the past few years. It's still 69 billion. So that's a big word of caution for that company. So is Enbridge a good investment? So before we actually be able to conclude on that question, let's look at the pros and cons of Enbridge. So a pro in Enbridge is that it's got pretty predictable cash flow, recurring revenue because it's got a big moat. It's got this big pipeline. Second is it's on fixed contracts, long-term fixed contracts with oil suppliers, and they're not really tracking on commodity prices because they get paid by volume. Third is that it is a dividend king. It's been paying dividends for the past 65 years and increasing its dividends for the past 20 years. Now, some cons that I'm seeing is one, it has a high amount of debt, more than what I'm comfortable with, like 69 billion, and there's no showing that it's decreasing its debt in the past few years. Secondly, it's a capital intensive company. So the only way it's going to grow is to employ more capital to build more pipelines, which means incurring more debt so that it could grow its revenue, which is something that I don't really like. Third part is that it's not meeting revenue expectations. And the fact that its revenue is expected to drop over the upcoming 1 to 2 years is kind of a downside for me. What is my closing thoughts about Enbridge? I think given its pros and cons, I would say that you should proceed with caution. I own positions in Enbridge and I love its dividends, but I don't like the fact that its revenue has been dropping. And more importantly, that it could impact its dividends, and the fact that its dividends is likely not going to increase 10% year over year. I think that there probably is better investments out there. Now, of course, if you are an income investor and you just want to rely on safe, predictable income, Enbridge is one of those companies that have been existing for for a very long time. They have an incredible moat. No one is going to take them out because they have very expensive pipelines to maintain, and they've been paying dividends for the past 65 years. My only caution is that they're likely not going to increase its dividends 10% year over year. So if you're looking for capital appreciation, I would say Enbridge is not a company for you. But if you're looking for income or predictable sources of income, I think Enbridge is a great dividend play, but don't expect 10% year over year increases in its dividends. Anyways, I hope you found this video super helpful. If so, give me a thumbs up, and I'll see you in the next video.